Hello and welcome to this video on profit, profitability and ratios. Previously we've been looking at the finances of a business and we established that profit is the difference between money coming into a business and the money going out of a business. And we're going to look at profit in a bit more detail today. We're going to answer these three questions. There are three different types of profit in business and we need to know the difference between these three types and how we refer to each. Secondly, we're going to look at profitability, how we can measure how profitable a business is and make comparisons between businesses. And then lastly, look at how a business might increase its level of profitability. So let's start off with a quick reminder of what profit and loss is all about. Profit is the difference between revenues and costs, so total revenue minus total cost. If there's money left over, a surplus, we have a profit. If there's a shortage, then we have a loss. Now in business, there are three different measurements of profit, and we should take these definitions down in our notes. The first one is gross. Not gross because it's disgusting, gross because it's at a larger, wider scale. And the formula for gross profit is revenue minus cost of sales. Revenue minus cost of sales, where cost of sales are the direct costs of the business, i.e. buying the units for resale. So for example, if you have a t-shirt business, the revenue would be all the money they receive from selling their t-shirts, subtract the cost of buying in the t-shirts themselves gives you the gross profit. Gross, it's kind of large, it's like saying how much have they made just from the core activity of that particular business. What is it the business really does? How much profit do they make from doing that activity? Our next type of profit is operating profit. And operating profit looks at the profit the business is generating as a whole, as an operating business. So we have revenue, we subtract the costs of sales, but we also subtract what are known as business overheads. The other costs of the business that aren't kind of direct, they're not involved necessarily with what the business directly does, but they are also costs of the business. So things like administration costs. So in our t-shirt business, we have revenue from the t-shirts, we subtract the cost of making the t-shirts or buying them in, but we'd also subtract any other regular costs that the business incurs, such as maybe some administration staff, the salaries we pay them for answering the phones and dealing with emails and so on. So that's our second type of profit, operating profit. Profit comes from the business operating as a whole. Now there might be a few other costs that the business might incur, and if we subtract those as well, we have the final profit, often known as the bottom line, and that is net profit. And to get to net profit, we have to subtract any other exceptional costs. So we have the revenue, we subtract the costs of all the items, buying them in, for example our t-shirts, we subtract the costs of any other sort of regular staff and things we might need, and then we subtract other things that aren't really part of the day-to-day running of the business. So for example, if you're paying interest back on a loan, it's not really a key activity of the business, you don't need to pay that to run the business, but it is a cost the business will incur. Similarly for tax as well. So those are our three types of profit. Okay, let's have a look at a quick example. And we're going to have a look at here as an example of the single greatest football team going around, so a football club. Now, if we think about gross profit for a football club, revenue will come from the fans buying tickets and buying shirts, and then we need to subtract off the direct costs, the cost of providing that service. And in this scenario, for a football club, the direct costs would involve the players' wages. So let's imagine that the revenue for the football club is £2 million and the direct costs, the costs involved in providing the core activity of the business are £750,000. That will give us a gross profit of 1.25 million. So the profit the business makes from running the core activity. Now, a football club might well have some other costs, perhaps some staff who work in the shop selling merchandise. There might be a number of indirect costs that the business pays out. These are not the direct costs of providing the service, but there are other costs that the business would have to pay out in order to function. So let's imagine that the indirect costs are £500,000, and therefore our operating profit would be the gross profit of 1.25 million, take off our extra indirect costs that we require to run the business to give us an operating profit 0.75 million. So this is the profit the business would make from just running its normal operations. To get to profit for the year, or net profit, we have to take off any final exceptional items. So if we imagine, for example, that this club have taken out a loan to buy their ground and they have to pay that back with interest, those interest payments would be coming out now at this stage to get us towards our profit for the year. If we imagine those exceptional items are £400,000, our final profit for the year would be the operating profit, £750,000, minus the interest payments, £400,000, to give us a final net profit of £350 million. And for the avoidance of doubt, this figure is before the business has paid tax. So any corporation tax will be paid on this amount. Now, a business will record its profit in what is known as a statement of account. So the three types of profit are set out in a standard format, and this is known sometimes as a comprehensive statement of income, or perhaps more commonly a profit and loss account, sometimes abbreviated to P&L. And this is the standard format that we would expect to see. So for example, in 2016, we can see the revenues listed first, 3,500, but this is in thousands, so that'd be £3.5 million. Then the cost of sales, and if we subtract the cost of sales, the direct costs of running the business, we would get the gross profit. Then as a business, you would present the indirect costs, for example, administrative expenses. Again, here we go, over on this side, we take those off, we get to the operating profit. So the profit the business makes from its operations. Again, the business might have some exceptional items, for example, financing costs. And if we take those off, we get the final level of profit for the year, or net profit. And if you look up any financial report from any well-known business, you will see a statement of accounts, a P&L, that is set out in this format. So we looked at the three different types of profit. We're now going to move on to profitability. So let's consider these three businesses: business A, business B, and business C. And what I'd like to do is just pause the video for a second and think which of these businesses is performing the best. Well, it might be difficult. It might be difficult to say which business is performing the best, because these businesses, looking at them, clearly are very different sizes. Business A is clearly the largest, £10,000 worth of revenue. Business B only has £100 of revenue, quite small, and business C is somewhere in between. So it's hard to make a comparison. What's better here, £2,800 profit or £30 profit, but that's only come from a much smaller business. So often in business, what we do to make comparisons is we use percentages. And if you were thinking of coming up with a similar idea when you pause the video to this, then you're right on the right lines. So these percentages down here are taking the profit, these different types of profit, as a percentage of revenue. So effectively saying how much of the revenue do they keep as profit. And because they're all in percentage terms, it's quite easy now to make comparisons. Even though business B is the smallest, actually it keeps the largest amount of net profit from its revenue. 30% of all its revenue it keeps as net profit. So you might say it's performing quite well at generating profit. But it allows us to make easy comparisons. And that's what profitability is all about. It's about how effective a business is at generating profit from its activities. So let's take this down in our notes. Profitability measures the financial performance of a business by comparing profits achieved to something else. For example, revenue. Comparing profits to revenue gives you an idea of how profitable the business is. And in business, we'd normally measure it by using three ratios, or coming up with three sort of percentage calculations. And these are gross profit margin, operating profit margin, and profit for the year, or net profit margin. And we need to know these three. The first one, gross profit margin. This is the formula, and I'd like you to take this down, please. Gross profit margin is gross profit divided by revenue times 100. So effectively it's saying what proportion of the revenues are kept as gross profit. So if the gross profit for a business was 200,000 and the revenues were 800,000, that would be a gross profit margin of 25%. They keep 25% of their revenue as gross profit. The next one is operating profit margin. Operating profit margin is operating profit divided by revenue times by 100. And again, it is expressed as a percentage. The final one, see where it's going, net profit margin, profit from the year margin, net profit divided by revenues times 100, Again, net profit margin is expressed as a percentage. Now these margins are very useful because they help us to compare businesses. So for example, in this table here, we have company A, B and C. We have sales, profit, and we also have operating profit margin. Now company A makes a higher profit than company B, even though its sales are lower, and that is because they have a higher operating profit margin. This business, company A, keeps 33% of their revenue, of their sales, as operating profit, whereas company B only keeps 10%. So even though company B is bigger and has more revenue, it doesn't perform as well in terms of profitability. It's not as successful at converting its revenue into profit. Company C makes the highest operating profit, 125,000, but it does not have the highest margin. It has the second highest margin. It only keeps 25% of its revenue as operating profit. So whilst it's the biggest company, here we might say that company A is the most profitable, it's the best at keeping or generating a profit from its activities. So it's very useful for us to make comparisons between different businesses. So that's the second objective. How can we measure and compare profitability? Let's go on to the third one now. What can a business do to increase its profitability? Increasing profitability is often a major aim for growing businesses. They want to retain more and more of their revenue as profit. And there are several ways in which they can do this. They could sell the same quantity but charge a higher price to their customers, and this would increase their level of revenue and hopefully increase their level of profit whilst not changing costs. Or they could just try and sell more units but keeping the price the same. Well, the final option is sell the same amount at the same price but try and lower their costs. Businesses could do one of these or several of these, but there are some implications. There are some difficulties in achieving one of these three things. So let's look at these in turn. The first one, how could they improve profitability? Well, they could just charge a higher price. If we look at this example at the bottom, the business currently selling 1,000 units at £45 and has a net profit margin therefore of 22% given the costs. If they raise the price to £48, then the impact this would have is it would increase the net profit margin to 27%. However, will we lose customers by charging a higher price? What if it happens if the price now goes above competitors' prices? How loyal are the customers? Will they have to spend more to maintain their brand image, to give the impression of a better quality perhaps, so they can retain the same number of customers? So these would be questions a business would have to consider first before they would go about this tactic to improve their profitability. The second option is to sell more at the current price. So for example, again down here we have our net profit margin 22%. If they try to sell more than 1,000, perhaps they sold 1,100, what impact would that have on net profit margin? Again, it would increase their net profit margin, increase their profitability, here to 27%. However, how are you going to do this? How are they going to gain new customers? Is it feasible to attract them from competitors? Is there maybe a new market you could enter where you would have access to new customers? Would you have to spend more on advertising or marketing to attract these customers, and therefore would that just increase your costs and not have an impact on profitability? The final option is to cut costs. If we look again at our example, costs were 35,000. If we try and cut the costs, become more efficient to say 31,000, what impact does that have on the net profit margin? Well, it would move it to 31%. However, if you cut costs, will the quality be affected, and will you maybe lose customers as a result? Could your image be tarnished, maybe give the impression that it's a cheaper, less quality good? How realistic is it that the business can become more operationally efficient at producing? How realistic is it to reduce the costs, and what might a business do in order to do it? Again, these are some questions the business would have to answer before deciding on this particular tactic. Okay, so we looked at the three different types of profit: gross, operating, and profit for the year. We've looked at how we can measure profitability and why it's useful, so we can compare businesses. And then lastly, we looked at the three approaches a business might consider to try and increase their profitability, but potentially some of the drawbacks to those approaches as well. That's it. That's all. Thank you.